Okay, you're broadcasting to all attendees now, so I'm going to go on mute.
Good afternoon, everybody. I'm Dave Duncan, Chairman and CEO of Duncan Financial Group. I first of all want to thank everyone for taking the time today. We have allocated 1 hour for a comprehensive update on what the COVID-19 virus means to you and your business. I want to make sure everybody is doing everything they can to stay safe and healthy. I hope all of your friends and family and loved ones are safe and healthy. We wanted to showcase our unique ability to help a business owner across the board with the many different parts of their company that are being affected by the virus. We do pretty much everything financially except banking. So whether it's employee benefits, human resources, tax and accounting services, 401k plans, business insurance, we handle all those things. And the uniqueness is it's all under one roof, all with a group of professionals. During this seminar, we're going to have Brad Prentice talk about benefits, Jen Roman talk about HR, Dan and Tony talk about tax issues, David Lang talk about commercial insurance, and Alex Klein and Brian Duncan will talk about 401k and other qualified plans. We'll leave some time for question and answers at the end. I would point out to you that of those 7 presenters there, they average 21 years of experience in their field. So we've got a deep team of credentialed professionals to help you with the impact on your business of this virus. A couple of quick housekeeping items. Number one, you're able to ask a question through the Zoom connection. We will take time at the end to answer those questions. If we don't get time to answer all the questions, we will get back to you concerning that. We are going to be sending out the entire slide deck to all of the participants in this Zoom conference. So you can take notes if you like, but you'll have access to the entire deck whenever we're finished. And we will also have a replay of this conference, of this video, on our website, so you can reference it again. One of the big challenges we had in putting this presentation together was taking the significant data and significant information here and distilling it down to 10 to 12 minute presentations per department. So what we decided to do starting next week is we'll have an hour-long session for each of these departments in each of these areas, so that if you have specific issues and needs in that area, we'll be able to drill down more completely. To get us started, I'm going to turn it over to Brad Prentice. Brad is the executive in our benefits department, and I'll start it out, Brad, with a question. What should a business owner be thinking about today relative to their employee benefit programs?
Dave, probably the most important thing is for each and every employer to keep up to date on the webinars or the guidelines that each and every insurance company is putting out there. So please pay special attention to those. Some of the questions and concerns, though, that I'm getting are, what is an employer to do if there is a concern regarding infected people? The answer is easy. Employers are permitted to ask any recent travel or exposure to COVID-19 or contact with others who recently traveled to at-risk countries or have been exposed to the virus itself. If an employer has a reasonable belief that the employee is a health threat to others, it can ask the employee to stay home for the 14-day incubation period. Employees must be eligible for some paid and or job protection should they leave, based upon the federal and state guidelines of that state they might reside in. Another question concerning employers and employees. Can you administer a medical test or take an employee's temperature as a condition of work? The American Disabilities Act standards still apply, even in a pandemic. The ADA generally prohibits employers from requiring medical examinations or making disability-related injuries unless, number one, the exam or inquiring is a job-related or consistent with the business necessity, or number two, the employee's condition could pose a direct threat to the health and safety of those individuals working at that employer group. Please be advised, effective last week, the EEOC does permit the employer now to take an employee's temperature on worksite. Another question, during the pandemic, how much information may we request from an employee who calls in sick, and can we send employees home if they display influenza-like symptoms during the pandemic? The ADA covered employees may ask their employees if they are experiencing influenza-like symptoms, such as fever, chills, coughs. If so, that information must be maintained as confidential medical records. 2, if an employee becomes ill with symptoms of influenza-like illness during a pandemic, the CDC states that the employee should leave the workplace immediately, advising workers to go home, because although this is not a disability-related action, the illness is to akin of seasonal influenza. Additionally, the action would be permitted under the ADA if the illness were so serious that it could pose, again, direct affliction to the employees of that company. Now, inside of group benefits, the areas we're going to see probably prop up, and if you don't currently have a telemedicine program in your group, please contact me or anybody else in the EB department because they are available. Good things about telemedicine. It's a valuable option for those seeking medical help for non-emergency care. These services often provide access to care and specialist referrals while minimizing external exposure, while also saving emergency resources for those that need it most. Employee assistance programs. Next page, please. Employee assistance programs also provide helpful benefits not only to physical, but mental health, personal finance, stress management, substance abuse, and relationships, all potentially critical services during these uncertain times. And finally, health plans may cover the cost of COVID-19 testing. Many states have mandated that fully insured plans must cover COVID-19 testing and treatment at no cost to their members. While self-funded plans are not generally subject to these state mandates, most claims administrators are automatically waiving the COVID-19 testing and treatment costs. Now, based on the 3 main carriers we have in Western Pennsylvania, next page, please. Next slide. Based on the charts you're going to have on the next slide, please pay special attention to which carrier you are currently insured with here. If you are self-insured or have another carrier other than these 3 currently posted on this webpage, please reach out to us and we'll be happy to go over these situations intact. At this point, I'd like to turn it back over to Dave Duncan and continue in the HR area with Jen Roman.
Thanks, Brad. Appreciate that. Excellent update there. Jen Roman, our HR specialist, is going to give us some information here. What should the business owner or HR professional be worried about at the moment concerning their program?
Thanks, Dave. There's several things that employers should be aware of, starting first with the Families First Coronavirus Response Act. The Emergency Family and Medical Leave Expansion Act applies to those affected by childcare. So any child under 18 or a child over 18 with a mental or physical disability would fall into that category. Employees should receive no less than 2/3 of their pay, up to a maximum of $200 a day or $10,000 per benefit period. The first 10 days would be unpaid, but employees can substitute any available vacation or personal time if they have it. The same job protection would apply to them that would under the regular FMLA guidelines, which would be 12 weeks in the state of Pennsylvania. Covered employers include private businesses with less than 500 employees and all public employers. In order to be eligible for this expansion act, the employees must have worked at least 30 days. Some exclusions include healthcare workers and emergency responders, as well as businesses affected by a government shutdown, a stay-at-home order, or any business with less than 50 employees, which would experience a detriment to the business due to the absence. The next thing that I wanted to talk about is the Emergency Paid Sick Leave Act. There's two qualification categories that follow different pay procedures. The first is for regular pay up to $511 a day or $5,110 a benefit period. This would apply to those in quarantine or on an isolation order, those that were asked to quarantine at the advice of a healthcare provider, or those who are experiencing symptoms of the virus or receive a diagnosis. The second category is for 2/3 of the regular pay, up to $200 a day or $2,000 per benefit period. This would be for employees caring for a child that was displaced by a closed daycare, school, or otherwise sick provider, and those experiencing a similar condition specified by the Secretary of Health and Human Services. For those categories, the duration of pay for a full-time employee would be 80 hours. And for a part-time employee, they would be paid the equivalent of the hours that they would work typically in a 2-week period. Some guidelines that employers should be aware of: employers do have the right to ask for a periodic follow-up from employees after the first day they begin to pay them. There's no carryover into the 2021 calendar year. There is a poster that employers are required to post, and similar to the FMLA expansion, excluded are employers that are affected by a government shutdown, a shelter-at-home order, or those that would experience a detriment with less than 50 employees by the absent. Also included are furloughed employees. The next thing I want to cover is the Emergency Unemployment Insurance Stabilization Act and Access Act of 2020. This provides employees who are laid off with some enhancements. This would include a $600 a week payment of additional compensation, and that's added to the state calculation for unemployment. That runs from now and will extend through July 2020. There are newly eligible categories of employees, which include self-employed workers, gig workers, freelance workers, and independent contractors. And the duration of benefits has also been extended to include 13 additional weeks of payment on top of the state allotment for benefit weeks. And a few other things that employers should be aware of. The I-9 documentation verification process has been modified for employers who are fully remote at this time. There's two choices an employer would have. One would be to allow a household member to verify the documentation for new employees, or the employer can wait until their operations return to on-site to verify the documentation. And some other things that employers can think about doing right now would be temporary layoffs with callback dates, furloughs, and reduction of work hours. You can contact your representative at Duncan for more information on that, and I will turn it back over to David Duncan. Thank you.
Thanks, Jen. I appreciate that. I just want to remind everybody who may have joined us late is that you can ask questions through the Zoom portal. So if anybody has any questions as we're going through our discussions, we're trying to pack as much info as we can into 60 minutes. I'm going to turn it over now to Tony Marciano, who's an enrolled agent, and Dan Vecchio is a CPA, to talk about the income tax and accounting issues surrounding these recent packages were signed into law. Tony, what are you working with your clients on these days concerning these new packages?
Great, thank you, Dave. Two main areas that I want to hit on today revolve around two loan options. And why are these loan options even available? The main reason for such is that the two critical components of businesses that we are seeing being impacted by the COVID-19 crisis really revolve around that of employees and cash flow. And therefore, the government needed to throw a lifeline out to small businesses in order to prevent these two main areas from being impacted, and thus trying to preserve, if you will, the economic activity throughout the U.S. So there are a massive amount of details here that we can cover, but Dan and I have a very limited amount of time, so we're going to be covering these items at a very, very high level. The two areas that I want to focus on, the first would be the Paycheck Protection Program, otherwise known as the PPP loan. How do you apply for this loan? You will apply directly through your local bank, the bank where you would have a banking relationship with. Now, the key here is that your local bank needs to be an approved SBA lender. The bank here is merely a middleman, if you will, because ultimately they will then take that information and then send that directly to the SBA. The beauty of such is that because this is a 100% federally guaranteed loan, there is absolutely no underwriting requirements. There is no collateral needed. And ultimately, there are going to be no personal guarantees. So how do you apply? You're going to want to reach out directly to your local bank. We or you, the client, will then submit information directly to the bank. The bank will then forward that information to the SBA. The SBA will then review that information, and assuming that you qualify, those monies will then be released by the SBA to your bank then into your employer bank account. Now, that PPP loan, even though it is in fact designated a loan, the beauty of such is that it has a forgivable feature. And the forgivable feature is that when these monies are funded into your business bank account, basically you have 8 weeks in order to go through these monies. And within that 8-week period, you need to use 75% of that money for payroll and payroll-related items. Those payroll-related items would be compensation, wages, tips, state and local payroll taxes, group health insurance premiums, and ultimately the items that you need to be factored into that calculation to determine how much you would actually qualify for. Another item, you needed to have been in business by February 15th of 2020. The covered period here is February 15th through June 30th. So what that means is not only did you need to be in business by February 15th, but you need to apply for this loan by the end of June. But based upon the fact of the updated numbers of nearly $100 billion out of the $350 billion worth of allotted funds, the funds are being used up here quick. So my recommendation is to apply for this PPP loan sooner rather than that of later. A couple of final comments. Who qualifies? Any small business that has less than 500 employees. Now, this can be profit, nonprofit, and included within that nonprofit umbrella is also religious organizations. And how much is the amount of that loan, if you will? You're going to take your average monthly payroll for 2019 and multiply that by 2.5 times. Now, there's a couple of other numbers that go into that. And again, the details are important, but at a high level, it's basically going to be about 250% of your average monthly payroll costs. The second loan that I want to mention is the EIDL loan. This loan does not have a forgivable feature. It is like that of any other commercial loan. There's going to be underwriting. There may be personal guarantees. You may need to supply collateral. And therefore, our recommendation as a firm is to first pursue the PPP option. The only benefit of the EIDL loan that we see is that when you apply for this, and you can apply directly on the SBA.gov website, you could actually check a box and an immediate $10,000 grant will be provided to you within 3 days of that application being approved. And if you do get those monies, that $10,000 grant, in addition to you then qualify for the PPP loan, any monies that you would receive from that PPP loan would first be reduced by that $10,000 grant from the EIDL. So again, the one has to go directly through your bank, the PPP. The second, the EIDL, that'll go directly to the SBA.gov website. Dan, if you'd like to take care of some of the payroll tax credit items and the employer payroll tax holiday.
Great, thank you very much, Tony. The first one we're going to talk about is the employee retention credit. Who is going to be eligible for that? One, if your operation has been affected by the COVID-19 suspension order that your state governor has put out, you would be eligible for this credit. The other requirement, it's either or, is if your gross receipts have declined by more than 50% for your current quarter versus the same quarter as last year. And if so, you will be eligible for this credit. What is the credit going to be? The credit is going to be 50% of wages paid to each employee up to $10,000 of a maximum. Included in that number, you can also add company paid healthcare benefits as part of that number. Now, the trick here is the number of employees you have. If you're an employer and you have more than 100 employees, the only wages that are going to count towards this credit are wages that you're paying to your employees who are not working anymore. Those employees that are at home, but you elect to continue to pay, those wages would qualify for the credit. The good news is for smaller companies, less than 100 employees, you're going to be eligible to include all wages. Whether the employees are working or not working, you will be able to include those wages into this credit. This is going to be a quarter by quarter credit. And how would you receive that credit? When you do your quarterly 941 tax return, there's going to be a line to report this credit. So in essence, if you pay all your payroll taxes for that quarter, you're going to calculate that credit and the IRS is going to send you a refund on your 941. If you can calculate this as you go, you can decrease your monthly or semi-monthly payroll tax deposits to help out with the cash flow, but you want to make sure you still pay it enough so you do not incur any type of penalties for that. Now, these are going to include wages up to 12/31/2020. Now, if you're an employer and you claim this credit, you will not be eligible for either of the two loans that Tony mentioned. So once again, if you get the PPP loan or the EIDL loan, you will not be eligible for this retention credit. The second one is pretty simple. It's an employer payroll tax holiday. And what that is the employer share of the payroll taxes, which is that 7.65% of Social Security and Medicare that you match on your employees' wages. You're going to be allowed to take that amount for the balance of the year, the second, third, and fourth quarters, and not pay the company's share of the payroll taxes into the government. You can basically accrue those. Then at the end of this year, you'll have that total number that basically is for the balance of 2020, and the IRS is going to let you pay that into them over two installments, one at the end of 2021 and one at the end of 2022. So this is really to help you out from a cash flow perspective. And once again, if you're eligible for the Paycheck Protection Program loan, you will not be eligible for this payroll tax holiday. And I'll send it back to Dave.
Thanks, Dan. I appreciate that very much. Great presentation, guys. That's obviously a big part of a business owner's life, is deciding which elements of these new stimulus packages to implement. Next, we're going to turn to Dave Lang. Dave is going to talk about the commercial insurance aspects of what's going on. And I guess the first question, Dave, is what kind of questions are you getting from your clients?
Well, the biggest concern that we have for our clients is also where we're getting most of the questions, and they revolve around cash flow and expenses. The most common question does my business income cover us during the shutdown to the virus? A business income policy requires both direct property damage and damage caused by a covered loss. Virus is not a covered peril. It's actually mandated by the state that it be excluded. And obviously viruses do not cause damage to the property. Therefore, as interpreted today, the business income doesn't apply. However, as a member of the Technical Affairs Committee for the Independent Agents, I've consulted legislators from around the country. There is potential legislation being proposed in Pennsylvania, New Jersey, Georgia, and many others. These may have the ability to help business owners later out if they are passed. There's also discussion with regards to federal changes as well. We are also seeing lawsuits brought forth by policyholders making arguments that coverage should apply. And if these lawsuits are successful, that would basically establish new case law. And therefore, we are monitoring both closely because both of them can have the potential to understand or change the interpretations of policies and allow them to pay the claims. The second area that we are receiving questions on is relating to decontamination or cleaning of facilities. Unfortunately, much like business income, virus is an exclusion. However, some businesses do have pollution policies that may apply, but ultimately you need to review your policies with your agent to determine what coverages you have and do not have. A significant concern that business owners should have is that property policies contain a vacancy or occupancy limitation that after 30 or 60 days, there could be changes in your coverage if your building is vacant or unoccupied. Some policies actually have language that your business may have to be actively operating for there to be coverage. So showing up to just check on your property or the owner showing up every day to work is not then be determined to be actively in business. Therefore, once again, it's important that you review your policy with your agent. However, the biggest concern that business owners should also have is are they having changes in their operation, whether they're partially shut down, fully shut down, or are they changing what they're doing to keep their doors open? You know, we applaud those that are trying to adapt their businesses, and we're here to help and support them in those changes. But you need to make sure that if you're making changes in your operation, that you have a discussion. We've seen restaurants and retail operations now doing delivery. You need to make sure delivery is covered. We've seen manufacturers that are selling products like masks, alcohol for sterilization, ventilators, or other things that are necessary today. You need to make sure you're covered for these products and services. But the other concern is that you don't accidentally breach someone's trademark or patent. The Defense Production Act does not protect you from patent infringement, and that action is actually excluded from a general liability policy and most directors and officers policy as well. So we recommend that you reach out and discuss what's going on to see how their changes can affect your coverage. But also, if you did make changes in your operations, or if you're partially or fully closed, please reach out so that we can do things like adjust sales and payrolls to reduce your premium outlays. Also, many of our companies are allowing changing of payment plans or even deferred payments to help with your cash flow. Shifting gears and moving on to workers' compensation, we are getting a lot of questions relating to what if an employee contracts the coronavirus. Typically, workers' comp does not cover things like the cold or flu, but ultimately you have to look at the course and scope of what the employee was doing to determine if there was coverage. In some cases, you need to determine what was the actual cause. And maybe if, let's say, they're healthcare or first responder, the insurance companies are more likely to accept it. We're also starting to see states pass mandating that the coronavirus will be covered by workers' compensation. So best rule of thumb is if you're aware of a situation, if an employee feels that they contracted it during work, please turn it in, even if they're feeling fine. You don't want to have a situation where they file a claim later on and you get fined for not reporting a claim. Just so you're also aware, if you do end up with a claim, we reached out to both the Pennsylvania Compensation Rating Bureau as well as the NCCI, and they have set up specific codes relating to tracking of claims of COVID-19. And the expectation is that they will hopefully not charge for those claims against experience modifier and future premium outlays. And
Dave, I know, again, you're inundated with questions, I'm sure, but what new risks or new issues do you see emerging for the business owner?
oh my, yes. We're seeing a lot of emerging trends facing our employers today. There's been a huge surge in the number of cyber phishing or cyber scams targeting. I even had a client today that said they may have seen one fictitious email a week. They're getting multiple ones a day now. Cyber criminals are teasing people by offering them information relating to the virus. The employee then clicks on it, and it's common for malware, ransomware, or even worse, key tracking viruses to be put in your system. A key tracker could allow them to get access to things like your bank accounts and your payroll records and steal money out of your accounts. So you need to make sure you alert all of your employees to double and triple check where emails are coming from, and even contact the person who sent it to you by a separate email, or ideally even by a phone call or text to verify that they sent you that email. With the significant number of layoffs that are occurring today, we're also seeing two very scary trends. First, we're seeing employees filing grievances, EEOC claims, or discrimination lawsuits saying, why was I laid off versus my coworker? That's discriminatory. So please make sure you document your files, have discussions with your attorney. And the second scary trend that we're seeing and we see it every time there's a major layoff with, let's say, an economic downturn. After you lay off your employee, the employee says, oh, wait a minute. By the way, I was injured on the job. I was trying to work through it, but I need to file a work comp claim. This obviously becomes a major concern as it becomes hard for you to then mitigate the claim, do transitional duty or light duty to bring them back. And this will lead to a much larger claim and probably future premiums. Therefore, it's important that immediately you do a robust acts investigation. Don't pencil whip through it. Truly dig in and understand what transpired, when it occurred, how it occurred, and then also determine if there's witnesses that can help corroborate that this did or did not actually occur. Also, when you lay off people, you can have them sign a form saying that they're not aware that they have been injured to that point. Now, it's not foolproof, but it does help defend the case, and what attorney is going to want to take on a case if the employer already stated that they weren't hurt before they were laid off.
Okay, Dave, what steps should the business owner be taking at this time in order to protect themselves from these new issues and new risks emerging?
That's a good question. When it comes to protecting yourself, best practices from a risk management standpoint, I would think you'd have to look at protecting your facilities, your employees, and third parties. When it comes to your facilities, make sure you're equipped with your usual hand sanitizers. You have sanitization procedures that for all your equipment and work areas that meet CDC requirements. That you may even want to improve the ventilation system in your building to increase the airflows to hopefully try to filter out any airborne virus if that's possible. From an employee standpoint, make sure that they have all the proper protective equipment, masks and gloves and things like that. Make sure that they have safe distances between them and coworkers at their workstations. And if you can't physically separate them because of distance, maybe use plastic partitions to prevent the spread of virus, much like you're starting to see at retail operations and grocery stores. Obviously continue to encourage everybody to socially distance themselves. A lot of clients are heeding recommendations to close down their lunchroom and have the employees eat at their desks or workstations to keep them distant. Obviously, many are not allowing any visitors into the facility, and that's much like what we're doing right here with this webinar. Try to contact or deal with your customers virtually wherever is possible. When it comes to third party, you do have to take aggressive steps to make sure you're not spreading the virus to a third party. One, because it's the right thing to do, but two, the transmission of disease is actually not covered by a general liability policy. So if somebody accuses you of it, you would not even have defense costs. So it's prudent to make sure anything that goes, out of your building or gets handed to a customer that has been cleaned before the customer touches it. But ultimately, in the end, the best practice is to always err on the side of caution. And the biggest thing that we see is if you feel you have an employee that believes that they were exposed to somebody, they should not report to work, even if they are feeling well. And with that, I hand it back to you, Dave.
Thanks, Dave. Excellent report there. I appreciate that. And just a quick reminder again to everybody, if you'd like us to answer a question at the end, please put that question into the Zoom conferencing capability and we'll be happy to address it. Next, we're going to turn the program over to Brian, my son. Brian, I know there's been a lot of issues relative to retirement plans that have been enacted lately. What does a business owner need to be aware of regarding their retirement plan?
Yeah, thanks, Dad. Alex Klein and I here would like to share some of the highlights that we're discussing with plan sponsors that we work with and really help them understand what is most important and what should they be thinking about as it relates to their plan. We'll cover both some of the changes with the CARES Act, but also how to help their plan participants and team navigate the turbulent market conditions that we're in here today. So from a CARES Act perspective, what we're highlighting are three primary factors as it relates to the impact on most qualified plans out there. The first two relate to, in effect, distributions from the plan. The first is what's called a coronavirus-related distribution or a withdrawal. The other would be enhanced or increased loan amounts that are now available to plan participants. Ultimately, to qualify for these, the plan participants need to be either directly impacted, testing positive for the coronavirus, or negatively affected. That could be furloughed, laid off, a reduction of hours, or other financial consequence. At this point, it's our understanding that the certification of that negative impact would be handled by the participant that then would allow them to qualify for some of these new options within the CARES Act. And then last, the third option would be the suspension or waiver of required minimum distributions for the 2020 calendar year. To look a little further into those, the required minimum distributions, these are both for 2020, and if a plan participant had to take their first opportunity to take a required distribution in 2019 that waited until 2020, that is also waived. So the details there of the coronavirus-related distribution, one of the highlights is that the participant can take this withdrawal and they would not be subject to the 10% early withdrawal penalty. As plan advisors, we're constantly counseling clients regarding their need to save for retirement, how these dollars will ultimately help them sustain their lifestyle in retirement, and that there's an early penalty to withdrawal. In this situation, though, given the broader circumstances, that 10% penalty is waived. In addition to that, normal 20% mandatory withholding to a distribution is also not going to apply to the CRDs. Unless the individual elects otherwise, the CRD or the distribution would be included in their gross income over 3 years. However, they have the full 3 years to ultimately handle the tax consequences, and we can counsel them further one-on-one. So what plans would this apply to? That would be, broadly speaking, an IRA, individual retirement account, a 401A, 401K, 403B, or governmental 457 plan, and it must be made to an individual between January 1st of 2020 and December 31st of 2020. In terms of a maximum, this is across all of their retirement accounts. The maximum aggregate is $100,000 or the lesser of their vested account balance. In addition to that, this 100,000 will extend to the enhanced loan options available. So if right now, if your plan includes loans, the general thought is that the maximum for those loans are 50,000 or 50% of that participant's vested account balance, whichever is less. Again, given in the CARES Act, the program is such that during the 180-day period since the bill was enacted, the participant can now take the lesser of 100,000 or 100% of their vested balance during that period. In addition, regarding existing loans that are already in place, so plan participants who may already have a loan now have a 1-year grace period in effect there. They may delay those loan payments due within their plan for 1 year from when that individual elects to begin that process. In this instance, our team of plan administration, your plan analyst, will work with the record keeper to make sure that these loans are handled and accounted for correctly. When we're adjusting the amortization schedule, we will take the lead on making sure that information is correct for you and your participants. Next is the looking at the required minimum distribution. So one update legislatively coming into this year was the Secure Act. And the Secure Act had a number of features for retirement plan sponsors in the marketplace. One of them was ultimately extending the required minimum distribution age to take a distribution from qualified accounts to age 72, up from 70 and a half. The thought process is, among other dynamics here, that with the low values in the stock market, everything else being equal, for plan participants or those that have a qualified balance that would rather not take a distribution, would rather not sell at a low or sell their holdings now, this ultimately allows them to keep their funds invested for the long haul. So we feel that this ultimately is a value add, especially for those that don't need to take a distribution from that standpoint. Then, in kind of summarizing here, before I turn it over to Alex Klein, we will anticipate continued guidance and developments as it relates to the CARE Act and plan sponsors. Your record keeper, if they haven't already, will likely be reaching out to you to talk about these changes. Now, all these changes that I talked about will be in effect plan amendments if you elect them. They are optional to enact. However, each record keeper, that being a John Hancock, a Voya, Principal, American Funds, Empower, they will ultimately have their own process for working with us to implement those. Some will take an opt-in approach where you have to positively elect to include these features in your plan. Others will have a negative consent approach where you'll have to opt out to not have these features included in your plan. And as you look at the retirement plan marketplace, just as you've seen from the broad team of our professionals, now is absolutely a time where we as retirement plan advisors and administrators earn our keep. It's very important for us to be in contact with our clients. And last week, you probably saw communication from your plan analyst to talk about what does the CARES Act mean to you, and we're happy to have those discussions ongoing. In another way here, as I transition to Alex to talk about plan participant outcomes and focus, when you have a stark contrast of the markets of last year, of double-digit gains in the S&P 500 and other broad indices to the bear market that we're in now, as plan advisors, it's absolutely an important time for us to be working with your plan participants and helping them make the best decisions possible. So with that, I'll turn it over to Alex Klein.
Thanks, Brian. Hello, everybody. Yes, we know these are very challenging times. And as Brian said, as of March 12th, the S&P index entered into a bear market territory with a 20% decline. What's most notable here is back in 2009, 8 and 9, when you had the financial crisis, that happened over a period of, a year, 18 months. This decline happened in a period of 3 weeks. So obviously your participants are nervous. They're very nervous. And we want to be able to be there to help them. For long-term investors, which your participants should be in their retirement plan, long-term investors, research has shown that it's generally not wise to try and time the markets in times of uncertainty, as it often results on missing out on markets recovery. Nobody can time the market. Nobody ever has been able to, and nobody ever will be able to time getting out at the right time and getting back in at the right time. It's an impossible task. One of the things we're doing with participants, and we've spoken with a ton of participants over the last couple of weeks, those individuals that are still working and receiving a paycheck, we're actually recommending that they increase their salary deferrals if they can to try to take advantage of buying stocks which are on sale. This is a compelling long-term buying opportunity, and we are making that recommendation for those participants. As we go on to the next slide, what you're going to see is you see a chart, okay, staying the course in challenging times. If you look at the top right there, it's, if you look at those who stay patient are often rewarded, right underneath that. So what you're looking at is the 5 biggest market declines in subsequent 5-year periods that we've incurred, a lot of us in our lifetime. Going all the way back to the Depression, all the way to the financial crisis back in 2007, 8, and 9. What you see, and we want to focus on this chart, is if you come down to the dark blue at the bottom, where it says the 5-year average annual total return, what you want to do is you want to come over to the far right, and you'll look, the average 5-year return of those of the 12 months of the S&P following those market declines is 23.15% per year. With the worst one being in the middle, you see the oil embargo of 73 and 74 of 17.39. So once again, you come up to the top, those who are patient are often rewarded. It's very hard. We know employees are dealing with emotions and everything that's going on. We're trying to get them to stay the course because in the long run, they will be rewarded. This market will recover. And if you look at the nenext slide, what you're doing is, so we're directing participants, again, as I've said, they've been calling us, they've been talking to me and my team members and a number of the professionals out at the corporate office in Irwin. People need help. They're looking for guidance. That's what Duncan Financial Group's all about. We're here to help them. If you look at that second bullet, Vanguard's Advisor Alpha Study, it says specifically, working with an advisor can add return through portfolio construction, rebalancing, behavioral coaching. We're here to help them. Behavioral finance, behavioral coaching. We're here to talk to them. We want to prevent them from making irrational decisions that could hurt them in the long run. You heard Brian say about retirement planning. A lot of participants and studies say that less than 30% of people are already set for retirement or on course for retirement. If they start dipping in and doing the wrong thing now, who knows where they might be. Studies also show that investors who have a financial advisor tend to be better prepared for retirement. That's who we are. Again, use our experience, use our expertise to help your participants. In times like these, behavioral coaching is crucial. Numbers are numbers, but we're here to help them through all the things that they need to do to get through this time, because we will get through. Okay, this virus will come, this virus will go, but this market will recover. It always has, and it will. So with that, I'm going to turn it back over to Dave Duncan, our CEO.
Thanks, Alex. I appreciate that. And at this point in time, we're going to get teed up for the questions that we've received so far. Brian, my son, is his computer is receiving the questions. So in a minute, we're going to go to him and go over some of the questions. But since I am a business owner and since I am an investor myself, there's two things about Brian and Alex's presentation that I wanted to resonate. And the first one is, with all the responsibilities that seem to be heaped on the employer as regard to qualified retirement plans, I find it very relieving that for both the loan provision of $100,000 or the coronavirus distribution of $100,000, you don't have to do the investigation to see if the employee is in fact eligible for that. The employee self-validates that, taking you completely out of responsibility for that. I like that concept. And number two, those numbers that Alex mentioned, being in this now, this is coming up on the end of my 41st year in this business. I've seen the downswings that Alex mentioned. I've seen the 23% downswing in one day in 1987. And there is always a different reason why the downswing occurs, but there is always an inevitable recovery on the other end. And that slide that Alex talked about, I think resonates that better than anything else you can say or do or think about. If you look at in the last 100 years, there has been 5 times the market has dropped more than 45% peak to trough. And the average recovery over the next 5 years from the bottom is 23% per year. And the worst recovery has been 17% per year. So I think it's really important to keep that in mind when you think about your own investments or when your employees come to you with issues and questions, that's important information to have. Brian, do we have any questions? Brian, I don't know if I don't think your video is on. I'm sorry, your
Sorry about that.
microphone.
Lip reading.
Okay.
This one is for Dan and Tony in the accounting world, and it's asking for ultimately the Paycheck Protection Program. What would prevent a business from qualifying for that program?
Yeah, Brian, I would say the only thing that would prevent them if they had more than 500 employees or $35 million in revenue. That really is it. Other than that, if you're like a single person S Corp and you really had no payroll cost, then you wouldn't really be eligible. Other than that, most businesses are going to be eligible. There may be a small handful of industries like the gambling industry that wouldn't qualify. But other than that, most companies are going to qualify for the PPP loan.
Thank you, Dan. We have one more here that I'll start with Jen Roman, and then if our accounting team has any additional insights, certainly feel free. The question is there a specific timeline for the additional $600 per week unemployment compensation? And are there any additional requirements to receive this benefit, or is it simply given by filing normally?
My understanding is that the additional 600 runs through the end of July, and there is no additional requirements other than filing for unemployment.
Thank you, Jen.
I would like to add to that. I think it's been very clear by the president as well as the Treasury Secretary and the Federal Reserve that they will do whatever's necessary to get our economy through this downturn. The Fed stepped in and basically saved the commercial paper market 2 weeks ago. They started buying municipal bonds. They have really backstopped the bond market that had some issues in this troubled time. And the president has pledged to, again, do whatever's necessary to make sure we get through this. So we've already had 3 stimulus bills passed, the most recent one, the CARE Act, Friday before last. Don't be surprised if there's more. Certainly work with all speed to get loan applications in, but I would not be surprised if there's additional loans available for those who might not have got it done in time, if there's an additional extension on not only the weeks of unemployment, but also the amount of unemployment. None of that would surprise me.
An additional question there from the Paycheck Protection Program. And assuming you do qualify and proceed, is there anything the business should be preparing to show how the funds were used? If they're audited ultimately for forgiveness, as an example, should the funds be kept in a separate account?
Dan or Tony, you want to tackle that one?
Sure, I'd be happy to tackle that one there. We are recommending to clients to set up a new business bank account so that those funds can be wired directly into that account, and then naturally to go ahead and pay any of those applicable expenses from that account. But the only challenge per se surrounding that would be, remember that the core bulk of these monies need to be tied to a payroll related account. So you might have to kind of shift over where some of the automatic drafts per se would be coming out of those bank accounts, not only for your rent, for your utilities, your retirement plan contributions, your group health insurance premiums, and your payroll account. So if you do set up a new separate account in order to receive those funds, just make sure that if you want to pay for all of those expenses out of that account, that you basically need to toggle and reach out to any vendors that you do business with so that they would begin to draft all of those costs, at least for the next 8 weeks, directly out of that new bank account.
Thank you, Tony.
You're welcome.
Okay, that covers all the open questions that we have.
I've got a couple of questions I'd like our team to expound upon if they could. I would first ask Brad Prentice, who runs our group benefits department, what portion of your clients have had some alterations, either furloughs, layoffs, or terminations of their employees over the last 30 days? Has it been a disproportionately large or surprisingly small number?
Dave, it's been, depending on the size of the industry and obviously what they do for their industry. It's been anywhere between 50 and 60% of our book has had some type of layoff or furlough. A lot of our employee groups are waiting to see what transpires through the month of April on whether they are continuing their coverage for their group healthcare or not. But it seems to be a wait and see situation as to what the government does, especially Governor Wolf and the state of Pennsylvania. I cannot stress enough to our clients to keep your ear to the ground and your eyes to the internet on each carrier's website that you participate in. If there's a webinar that they're putting on of that nature, please go to that webinar, listen to it, because it's an ever-changing status. UPMC is making daily changes, it seems, with respect to their groups and their availability of not only different coverages, but their offerings. So if you should have any questions, again, refer to that chart that will be coming to you via email that we'll be sending you. But then again, if you have any additional questions regarding your specific carrier, don't hesitate to reach out to one of the team members here.
Thanks, Brad. And I would ask a very similar question to Tony and Dan. Of your business clients, what proportion of those have you assisted in getting either the PPP loan or the EIDL loan?
Yeah, Dave, I would say at this point, we've talked to just about every one of our clients in regards to these two loans, and we got to be at 85 or 90% of our clients. We've either assisted and completed the PPP application, did the calculation for them, or walked them through it. Because once again, we just do not see any reason why they would not apply. So we got to be at about 90% of our operating businesses that we have spoken to and have applied for either one of the two loans. It seems like right now the PPP loan has been the more popular of the two.
Thanks, Dan. I'd just like to make a couple of quick updates here. I think it's important for you, our clients, to know where we stand on a number of these issues. First and foremost, I would tell you that we have applied for the PPP loan, pretty much for the reasons Dan said. There's really no reason not to. There's really not a downside to it. I would also tell you that we are very, very fortunate with our clients. We're so grateful that we are in businesses that provide ongoing regular revenue. Nobody has to walk into our store and buy a product one day for us to be able to continue to employ our employees. We get ongoing revenue from commercial insurance, from group benefits, from 401ks, from tax and accounting services, as well as our private wealth management businesses. So we're not anticipating any type of layoff at this moment in time. Obviously, it's a dynamic, fluid process, but we have not laid anybody off, and we don't intend to. We are working remotely extremely well. Our Chief Technology Officer, PJ Pizarro, got us up and running in less than a week's time with over 90 employees working remotely. We are abiding by Governor Wolf's social distancing and other programs designed to reduce the spread. So we have a very, very skeleton staff in there. We are allowed in our insurance and in our income tax businesses to do that. So we're not violating any of his rules, but we're there to serve and to help, and we're fully functional. We have daily telephone conferences and Zoom meetings, keeping up to date on all the things that are evolving. I would also mention some of the things that I said at the beginning. Everybody who's a participant will get a copy of this slide deck for their benefit, also with a little bit more specific drill down into each area, because as I said, each of these areas could justify a 45-minute to an hour webinar. Would also remind everybody that we are going to have a replay available on our website. If there's anything that you want to double check or you might have missed, we are going to have a replay available on our website. And lastly, I thank you so much for continuing to allow us the privilege of helping you with any part of your financial services needs. And if there's anything more that we can do, we'd be happy to do so. On the invitation that everybody received for this webinar, we do have the contact information for every speaker. So if there is someone specific that you'd like to talk to, you can hitting on that link on the original email. Thanks everybody for taking the time today. I'm going to thank our presenters, and please be safe.